Hello, and welcome to Structured Finance in Focus, a Fitch Ratings podcast that takes an in-depth look at the latest developments across global structured finance markets. My name is Ben McCarthy. I'm a Managing Director at Fitch Ratings and head up the analytical team for Asia Pacific for structured finance and covered bonds. On today's show, I'll be discussing structured finance in the Asia Pacific region, specifically Australia and New Zealand, as well as what we call non-China Asia. We're excluding China today as it can fill a whole podcast on its own, which we'll do at a later stage. Joining me today are Natasha Vojvodic, who heads up the analytical team covering Australia and New Zealand, and Atsushi Kuroda, who heads up the team covering Japan, Korea, and India. Thanks for joining me, guys. Thanks to the COVID experience, global economies have all continued to follow a very similar economic path, with interest rates dropping to zero during COVID and recently a rapid increase in interest rates. Given the change, we thought now is a good time to explore what we're seeing in performance of transactions we rate and what we expect to happen in the next 6 to 12 months. I might just start with Australia and New Zealand, Natasha. Maybe as a kick-off question, is there any evidence of deteriorating credit metrics in Australia and New Zealand given the rapid rise in interest rates?
In Australia, we have been seeing a deterioration in arrears. So the prime RMBS arrears ended last year at the highest level since the start of the pandemic, with the increase in the early stage arrears bucket being the most significantly. And this just showed that the ongoing inflation pressures and the 4.25% interest rate rises over the last 2 years were continuing to impact the borrower ability to make their mortgage repayments. On the positive front, we were not seeing the 60 to 89 arrears increase materially, meaning that most borrowers cured their first missed payment. The deterioration in our arrears index was also being seen by all four of the Australian major banks who make up the majority of the market, as they also reported a modest increase in arrears. As expected, Q1 has showed a continued deterioration in arrears. Arrears always tend to go up in the first quarter due to Christmas and holiday spending. While prime arrears haven't been this high in a decade, what we are seeing is the pace of increase in arrears is declining from growth seen over the December quarter. This is especially true in the first and second arrears buckets. So fewer new borrowers are going into arrears. And interestingly, the increase in basis points is also similar to what we would see in a typical first quarter. And so this may be a sign that arrears will not continue to increase significantly. Then the majority of the borrowers in the late stage arrears are either in hardship with the expectation that repayments will restart or selling their properties as they are not able to cure their arrears otherwise. We also have mixed portfolios in Australia. These portfolios contain borrowers with worse credit history as well as high proportions of self-employed borrowers with low documentation loans. And these portfolios have shown more deterioration than prime portfolios. Unlike what we saw at the end of last year, where the increase in arrears was mainly in late stage arrears, the Q1 for these portfolios is mainly in the early stage arrears, meaning more borrowers missed one payment and may move through the arrears bucket. On the other hand, 90-plus day arrears have actually reduced due to properties being sold. This is owing to property prices remaining strong. They've been increasing since early 2023 and have gone up by 2% so far this year. And this is mainly due to the undersupply of housing due to increased migration, extremely low rental vacancy rates, and low numbers of building of new properties. And strong prices have meant that although arrears have been increasing, losses have remained minimal. We're seeing the same deterioration in other consumer assets, so autos, credit card and unsecured consumer, as well as in SME portfolios. Even though some like auto receivables are fixed rate, inflation pressure and the rate increases are having an impact. The recoveries, though, remain strong and net losses remain steady. So auto arrears for Q1 are the highest since the beginning of COVID, but still remain below pre-COVID levels. Also, similarly to prime RMBS, the increase in that first quarter arrears is similar to pre-COVID levels. In New Zealand, while it's a smaller securitisation market and lenders may differ in terms of the borrower segment they service, broadly speaking, we are seeing very similar performance metrics to what we're seeing in Australia.
Thanks, Natasha. What are we expecting to happen in terms of transaction performance in the next 6 to 12 months?
Our expectation is that arrears will continue to increase over this year. So while there is a possibility of interest rates now staying higher for longer or potentially another rate increase, we do not expect a material increase in arrears. Borrowers have managed to adjust spending and have savings buffers built up over the pandemic, as well as inflation, while persistent, has been reducing. And those who have not been able to cure their arrears are able to sell their properties, so they are not expected to stay in 90-plus day arrears for long, as we've already seen in the performance of the mixed portfolios. The key here is unemployment. If this starts to deteriorate significantly, then I think we will be seeing very different performance. This is not our expectation, though, as Fitch forecasts unemployment to remain around the 4.2% level, so around where it is now this year, and increase marginally to 4.4% next year. And this is 5% in New Zealand. And so these are still relatively low numbers. We expect property prices to remain strong and increase between 4 to 6% in Australia, and a bit lower growth in New Zealand over the year, mainly due to the housing undersupply. This means, as we're already seeing, that if borrowers go into default, the property can be sold. And while our asset performance outlook for both RMBS and ABS remains deteriorating, our outlook on ratings remains stable due to the continued deleveraging of transactions and availability of excess spread to absorb any losses.
All right. One last question for you, Natasha. The transaction volumes out of Australia this year, I guess late last year, have been enormous, and there seems to be an insatiable appetite from investors. So this increased investor demand, I guess the question comes if there's any evidence that structures are changing as a result of the change in market dynamics.
We have seen some structural changes. So with the expectation of deterioration in the performance, as I've spoken about, more recently we have seen some transactions with wider arrears triggers to switch pay down from pro rata to sequential. So if this trigger is too wide, switching to sequential to bill credit enhancement will obviously occur later. And if the transaction is experiencing losses leading to charge-offs, this will lower protection for note holders, even those higher up in the capital structure. The purpose of this arrears trigger is to start rebuilding CE before arrears really deteriorate. The other thing that we've seen become a common feature, or more of a common feature in auto transactions, are commission or X notes, as they're known as. And this is the monetisation of unamortised commission paid to the brokers of the auto loans. These would previously have been paid out outside of the transaction by the lender, and these notes are not collateralised and are paid down according to a schedule. So the presence of these notes reduces the amount of excess spread to cover losses, as they are paid senior in the waterfall above the Class B notes. Another thing, which is not necessarily a recent development, is that some RMBS transactions have stepped down or residual interest on some notes after the call date. If the transaction is not called, a portion of the note holder interest becomes subordinated. There is a risk that note holders will not receive their entire coupon. Without this subordination of residual interests, these notes would not pass our and other rating agency stresses in the tail of the transaction for the target ratings. As this step down occurs after the call, and all transactions with this feature have called, to my knowledge, coupon has never stepped down. And this feature is not unusual in non-bank transactions and may be seen as market convention for those. And investors know what they're buying. It's very clear in the offering documents and in the relevant pre-sale reports.
All right. Thanks, Natasha.
Thanks, Ben.
We might move to the rest of Asia. Kuroda, you cover a really wide geography. Today we're going to focus on the major structured finance countries in your portfolio, being Japan, Korea, and India. So my questions apply to all three at once. You can answer them as one or individually. But I guess the initial question is, how has the ABS asset performance been trending this year in each of those countries?
Asset performance in these three countries has largely been stable in recent months. Our rated auto ABS in India are mainly backed by commercial vehicle loans, whose performance is sensitive to the country's economic activities. The stable asset performance in India benefits from positive business and consumer sentiment, and the government's continued push on capital spending and infrastructure, which sustain fleet utilization rates. We have not observed any trend in performance deterioration in Indian ABS. In Japan, we have seen slight deterioration in delinquency and default rates in our auto ABS index over the past few months. However, we still consider this phenomenon as a result of return to normal life post-COVID, and we do not expect the performance deterioration to continue far beyond the pre-pandemic level. The asset performance of Korea's ABS has remained stable, supported by a low unemployment rate, with the latest figure at 3% as of March 2024, against the backdrop of a robust economic environment, and no significant deterioration has been observed in either delinquency or default rates.
So what do you expect to happen in the next 6 to 12 months in these countries? We expect to deteriorate, particularly with interest rate rises in...
We do not expect any material deterioration in these three countries. For all of these three countries, we expect stable asset and rating outlook, driven by resilient macroeconomic environment, characterized by calming down of inflation, stable or improving GDP growth relative to the recent average, and low unemployment rates. While the transaction structure varies depending on countries, our rated transactions generally benefit from a relatively simple structure where credit enhancement typically increases rapidly during the transaction life. We expect this feature to provide additional buffers against unexpected deterioration in asset performance.
Okay, and so what should investors watch in those markets? I do note that, India has big elections on. Are we expecting any changes that might change the performance?
No, we do not expect any material change in the performance, and the potential effect which might be caused by election in India should be anyway temporary. So for India, we will monitor the overall economic growth because the obligors in our rated Indian ABS are small road transport operators who tend to be more vulnerable to economic shocks than salaried personal vehicle owners. We forecast India to be one of the fastest growing Fitch-rated sovereigns globally at 7.0% real GDP growth forecast in the fiscal year ending March 2025. Although geopolitical developments may potentially affect the asset performance, it's not our main scenario. For Japan, we will closely look at the real wage growth besides the unemployment rate. Real wage growth has been negative for almost 2 consecutive years due to the high inflation exceeding normal wage. This may, together with increasing interest rates, affect borrowers' debt servicing because as a result of a prolonged low interest rate environment, the proportion of variable interest rate in household debt, primarily comprised of mortgages, has reached the historical high. Also, the number of personal insolvencies has been increasing over the past year. However, we expect a low unemployment rate of 2.5% in our forecast for the next 2 years to continue to support stable asset performance. For Korea, high household debts remain a key issue for the consumer finance sector and could increase delinquency rates. Nonetheless, the Bank of Korea Central Bank has maintained its policy rate at 3.5% since January 2023 in order to manage this household debt issue. However, we expect stable asset performance in Korean consumer ABS to continue because the unemployment rate is expected to remain low and well below the recent average. We also expect the restrictive monetary policy and improving economic growth to continue supporting asset performance in Korea.
Thanks, Kuroda. It's remarkable how similar the performance is given the geography, the difference in the geography of those countries. We're going to leave it there. Thank you for your insights, Natasha and Kuroda, and thank you to the listeners who've joined us. You've been listening to Fitch Ratings Structured Finance in Focus podcast. To learn more about our ratings and research on structured finance, please visit us at fitchratings.com and please subscribe to our podcast on iTunes, Spotify, or wherever you get your podcasts. Thank you.